Imagine waking up tomorrow morning. You grab your phone, open your investing app, and without thinking twice, you tap Sell. But here's the problem. So does everyone else. Not thousands of people, not millions. Everyone. Every retirement account, every hedge fund, every billionaire, every pension fund, every investment bank, every day trader, every company, everyone wants out. So, what happens? Does the stock market instantly become worthless? Does your retirement disappear? Does the global economy collapse in a single day? Or is something else happening behind the scenes that most people never think about? Because here's the truth. The answer isn't what most people expect. In fact, the market can't even function the way most people imagine. And to understand why, we have to answer one simple question. When you press Sell, who's buying? Most people picture money simply leaving the market, as if your shares magically become cash. But that's not how it works. Every trade has two sides. Every seller needs a buyer. No buyer, no trade. Let's say you own one share of Apple. It's trading for $210. You hit Sell. But nobody wants to pay $210. So what happens? Nothing. The trade doesn't go through. Maybe someone offers $205. Still no? Then $200. Then $190. Then $170. The price keeps falling until someone finally says, "I'll buy." That's how markets work. Prices don't fall because companies suddenly become worse. They fall because sellers become more desperate than buyers. Now imagine that process happening to every stock on Earth at exactly the same time. Within seconds, trading algorithms detect something is wrong. Computers begin selling automatically. Large investment firms reduce risk. Market makers widen their spreads. Liquidity starts disappearing. Normally, there are thousands of buyers waiting. Now, there are hundreds. Then dozens. Then almost none. Prices begin falling. 5%, 10%, 20%. The news interrupts regular programming. Breaking news. Markets are crashing. Red numbers cover every screen. Social media explodes. People post screenshots of accounts losing thousands, sometimes millions, in minutes. Now something interesting happens. Millions of people who weren't planning to sell see everyone else selling. And suddenly, they panic too. Fear spreads faster than facts. One person sells because prices are falling. The next person sells because the first person sold. Then another. Then another. Eventually, people aren't selling because they analyzed the companies. They're selling because everyone else is. It's one of the oldest forces in finance, and it has a name: panic. But before the market completely spirals, something unexpected happens. The exchange steps in. Most major stock markets have automatic safety systems called circuit breakers. If the market falls too far, Just long enough. trading stops. For people to breathe, to think, to stop making decisions based purely on emotion. It's essentially the financial equivalent of hitting the pause button. But here's the catch. Stopping trading doesn't create buyers. It only delays the problem. Because eventually, the market has to reopen. And when it does, people still need someone willing to buy. Now here's the question everyone is wondering. If prices are collapsing, where did all the money go? Did it disappear? Not exactly. Let's imagine Apple loses half its market value tomorrow. Did half of its factories disappear? Did millions of iPhones suddenly vanish? Did every engineer quit overnight? Of course not. The company is still making products, still selling services, still generating revenue. The business didn't disappear. Only the price investors were willing to pay changed. Think about your house. Imagine your home is worth $500,000. Tomorrow, you desperately need cash. The only offer you receive is $250,000. Did your house suddenly shrink? No. The value of the building didn't change overnight. You simply accepted a lower price because there weren't enough buyers. Stocks work the exact same way. Price and value are not always the same thing. In fact, sometimes they're very different. Now here's where everything changes. As prices continue falling, new buyers begin appearing. People who have been waiting, people holding cash, value investors, large institutions, pension funds, long-term investors. Someone looks at a profitable company, selling for half the price it was yesterday, and starts asking questions. Has the business actually changed? If the answer is no, then maybe it's a bargain. The lower prices fall, the more attractive those opportunities become. History has shown this over and over again. When fear reaches its highest point, someone eventually decides it's time to buy. Now let's push this thought experiment even further. What if nobody bought? Not one person, not one company, not one institution. Nobody. Could that happen? Technically, prices could continue falling, but think about what that would actually mean. Imagine Apple, worth less than the cash sitting in its own bank accounts. Imagine profitable companies selling for less than the buildings they own, less than their equipment, less than their inventory. At some point, someone with available cash would almost certainly see an opportunity, because owning a profitable business at an incredibly low price can be an attractive investment. That's one of the reasons markets eventually stabilize. The lower prices go, the more people begin asking, what if everyone else is wrong? And that's when buying starts. So, what would actually happen if everyone tried selling their stocks today? Markets would crash. Trading would likely stop multiple times. Fear would spread across the globe. Billions, possibly trillions, would disappear from stock prices. On paper, but businesses wouldn't instantly stop existing. Factories would still operate. Planes would still fly. Packages would still arrive. Employees would still go to work. Customers would still buy products. The economy wouldn't disappear overnight. The stock market isn't the economy. It's a marketplace where people constantly negotiate the price of ownership. And prices can change much faster than reality. That's the biggest lesson. Markets don't collapse simply because everyone wants to sell. They collapse when fear becomes greater than the price someone else is willing to pay. Eventually, those two forces meet. Buyers return. Confidence slowly comes back, and the cycle begins again. So the next time you hear someone say, everyone is selling, remember one thing. For every share that changes hands, someone made the decision to buy it. And that simple fact is what keeps the entire market alive.